There's a $5 trillion question confronting the Indian economy at this time. And the question is this: does the Modi government have a credible plan to revive the Indian economy? What is it that led to the mess that we find ourselves in? And what's the best roadmap to help the economy bounce back? To discuss and debate, we are joined at Business Today MindRush by some of the sharpest economic minds in the business. I want to begin by introducing Dr. Ashima Goyal, member of the Prime Minister's Economic Advisory Council. Ma'am, welcome. Flanking her is Samiran Chakraborty from Citibank, chief economist over there. We've got Panda. For a government that's accused of not understanding enough about numbers in the economy, here's a man who does, and he can tell us about what the government is doing and whether that's effective to help the economy bounce back. Then we've got Mahesh Vyas from the Center of Monitoring of the Indian Economy, a man who does understand numbers and throws them up in a manner that very often the powers that be don't particularly like. Last but not least, I want to introduce to you the Chief Economic Advisor of the State Bank of India, Soumya Ghosh. So welcome to all of you, and it's great to have you with us at Business Today MindRush. The first question that I want to put to this very distinguished panel is this. The government says more than a couple of dozen measures have been rolled out, and these measures are already beginning to have an impact in reviving the Indian economy. I want to start by asking Dr. Ashima Goyal if you think that what Nirmala Sitharaman and her team at the Finance Ministry have already done is enough to see the economy bounce back.
I think that this is a time of healing, a time of listening. This is what Nirmala Sitharaman has been doing, getting feedback from, I think many of the people in this audience have probably given feedback and acting on it. Because it's correct, we went through a time of disruption. It's a time of major reform, structural reform. And in my view, the cyclical aspects were neglected, even in the macroeconomic policy. It was more structural inflation targeting, which was followed quite strictly, fiscal responsibility. And there were shocks, tightening in all directions, starting from reducing corruption as part of formalization of the economy. So, and then regulation was also pro-cyclical when it should be counter-cyclical. So we had everything that was sort of moving together and delivering blows. So in a way, now we are listening and responding. But at the same time, the structural reforms framework is there as a long-term background. Ultimately, we do have to make doing business easier. We have to improve labor laws, etc. But when people say that it's a structural issue and you have to, then you are neglecting the short term, and you can go into a deep dive in the short term if you don't have counter-cyclical measures, if you don't apply a healing touch. So we had experts who'd come from maybe the US and did not understand the economy very well, did not listen too much. So now people are listening and course correcting.
Mahesh Vyas, do you believe what's already been done by the government with all the sectoral steps that have been rolled out is enough to help the economy bounce back?
The measures taken recently will take time to take effect. It's difficult to say that these are already having an impact. So policy measures do not have an impact which can be so immediate. And if there are some that can, then I will say that they are not playing out as yet. The most important thing that I will watch out for is if industrialists are enthusiastic of putting money on the table. And so far, there is no evidence at all in this year and in the previous year as well to see any enthusiastic large investment being announced by the private sector. So at least from this point of view, are those announcements making a big difference to people in terms of putting investments on the table? The answer is a clear no. The rest will take time to show. There is nothing to show on jobs, of course, but that takes time to happen. The first thing we need to see is if those announcements are leading to investment announcements. Forget the real investments. So I don't think we are still seeing the impact of the
Jay
announcements.
Panda, private investment at this time is at a 16-year low. The litmus test for any government and its measures is, are Indian industrialists willing to invest in the India story? The empirical evidence to that question at this time is no. So yes, your government is now doing a lot of damage control, but at this moment there isn't enough empirical evidence to suggest that this is inducing greater confidence in the Indian economy.
I think one bit of context first is that in the past 18 months, most of the world's economies have seen reduced growth, and India is not an island in that sense anymore. And there are internal issues to which I think Dr. Goyal and others have referred to. Your question was whether the steps taken by government have had an effect yet. And there was a question about private sector confidence. I want to point out some of the auto industry leaders, and auto industry is the one that has been highlighted as having slowed down quite a bit. Some of its leaders have said that its problems have nothing to do with government. It has had to do with their own hubris, if you will, in not modernizing, not coming up with the models that people want to buy. Certain new entrants are sold out for the next 6 months. So, and when it comes to private sector investment, I agree. I think there seems to be an issue about people waiting and watching a little bit. But if you look at foreign investments, you look at the very large Amazon investment in Hyderabad, if you look at the Apple phone production unit starting in India, these are, I think, significant milestones. Now your question, are these measures that the government has taken, are they having effect? Now remember, the numbers that we are looking at for the past quarter, that's exactly the quarter in which the government did start taking these measures after it was sworn into office after the election. Now, I believe that we are already beginning to see a bottoming out. So let's take GST collections. Now, GST is one of the major, probably the biggest structural change we've ever had in the economy, as some of the co-panelists were referring to. Now, just under a year ago, GST collections had started crossing 1 lakh crores every year, and we were celebrating. And then a few months ago, it dipped below 1 lakh crores. But if you look at the last quarter, the low point was September. It went down to about 91,000 crores. In October, it came up to 95,000 crores. And the November numbers are, it is back up at a bit more than 1 lakh crores. So this may be one indicator that the bottoming out has already happened. I'm keeping my fingers crossed that in the coming quarters, I'm hoping to see a slight turnaround. And do remember that if we don't just get focused on the current quarter, if we look at a year or 2 year scenario, the IMF and many other people who are in the business of analyzing economies are predicting that India will be back up to a 7% growth rate in about a year's time.
The government says, Samiran, that a lot of the malaise that faces the Indian economy is part of a larger global slowdown. Critics would argue a lot of this disruption is self-created and we could have done without some of the measures or done them differently. What's your view at Citibank? How much of the mess that we are dealing with at this moment is self-created and how much is part of a global slowdown? Because there are countries like the Philippines, there are countries like Bangladesh, which are growing much faster than India is. So India has lost the tag of being the fastest growing economy in the world.
So to start with, it's very interesting that if you look at India's share in global exports, it has actually gone up despite India's own export growth being negative. So it's true that we have also been impacted. That's where the negative export growth comes. But in a relative sense, we have probably done somewhat better. But that's only on the export side. Indian economy is primarily domestic. So exports are 20-25% of GDP. You still have about 75% of GDP, which is domestic. And that's the segment which, in our view, probably started worsening not just in 2019, but maybe in early part of 2018 itself. And what happens is when the economy is in a momentum, then for a few quarters, we don't realize that the seeds of slowdown are already in place. And that's why probably we were a little late in responding to the slowdown. And similarly, the measures that we are taking today, we are getting impatient that why aren't they showing results right now? They will show results with a bit of a lag. So something like interest rates, it takes about 3 to 4 quarters to have impact on investments. So the interest rate cuts that have been effected will probably show up somewhere in the middle of the year, next year. And similarly with the corporate tax cuts, a similar impact can come. So I am in the camp which believes that a significant amount of counter-cyclical fiscal and monetary stimulus has already been given to the economy. We now need to be a bit patient to see it pass through the system and show up in numbers.
Soumyakanti Ghosh, do you agree with the criticism that the government was in denial for way too long, refusing to recognize the reality that stared itself in the face, that the economy was slowing down? They were caught in this sense that all is well and that there isn't a problem. And it's only once the economy really started hurtling down a slope that they realized that there is no option but to resort to some desperate measures.
Thank you, Rahul. Before I start, I'd like to congratulate you on timing the conclave on one of the most important days today. I think two most global developments happened today which could have significant ramifications for the global world and the Indian economy. The US-China trade deal possibly is coming to a conclusion, and the second, the election of the Boris Johnson. So both these things are positive for the global economy and the Indian economy. So that's a excellent coincidence. Now, having said that, the point which you tried to make is that yes, the economy is in a slowdown mode, and possibly it has been more entrenched than what it was anticipated. But if you actually go back for the last 10 years, from 2008 to 2018, India and China now constitute 19% of the global GDP. It was at 9% 10 years back. And India has added 150 lakh crores to its GDP over the period of 10 years. So that means 15 lakh crores every year. And even if we grow at 5% this year, I think that number should be around 15 lakh crores. So that means that even at this 5 lakh crores, which is of course not the growth rate we aspire to, India is going to add around 14 to 15 lakh crores. But the problem is it has been a combination of demand and supply factors. Demand primarily is that there has been a significant wage slowdown, rural and urban, for different reasons which we can discuss. And the second thing, there has also been a supply of fund slowdown, the NBFC sector. So possibly that these two factors combined may have put the slowdown in a sudden accelerated mode, but somehow with some green shoots now happening in the last November, I think the worst might be over for now.
Okay, so let's take that as the next question, and this is what everyone thinks about, discusses the most. Is the worst of the slowdown behind us? Will the next quarter numbers reflect that the economy is bouncing back? Or are we very worryingly headed towards a period of stagflation? Let me put that question first to Mahesh Vyas. 4.5% was the growth rate of the GDP in the second quarter. Everybody's faces fell, hearts broke. Is this the worst? Because we are now closer to what used to very cryptically be called the Hindu rate of growth than the Modi promised rate of growth, which is double-digit growth. So we're closer to 3.5 than we are to 10. Is the worst behind us? Will quarter 3 for the Indian economy be better than quarter 2? Mahesh.
Well, I wouldn't venture to forecast the GDP growth rate. There are problems with the way the GDP growth rates are calculated, and there are complications over there. I wouldn't like to get in over there. But I can still answer your question another way. I don't think we are seeing a bottoming out. I don't see this to be a point of inflection where we will see a turnaround now. We are seeing the worst growth rate and things will be hunky-dory hereafter. The most important sign has to be that investments have to pick up. And I don't see any sign of the investment picking up. We are into a situation where a persistent fall in the investment rate from 2011-12 all the way till 2018-19 has led to a fall in the growth rate of consumption. So investment slowing down has led to a consumption slowing down, which now is actually kicking back into people not investing. So where will you come out of this from? It cannot come out automatically. There's no low point from which you can bounce back automatically. So I don't see any sign of any kind yet on the horizon to say that we have bottomed out and something is going to come back again.
Samiran, do you see signs of a recovery? Do you believe the worst is now behind us? And why do Indian economists keep getting their GDP forecasts so horribly wrong?
Well, let me take that blame first. As in my 20 years of covering markets, I think this is the largest intra-year growth revision that I've ever done. I started the year with 7.1 and now down to 4.9 for the full year. I don't think a 220 basis point cut in GDP forecast we have ever done. And it makes us think that is this slowdown somewhat different from the rest of the slowdown that we have seen. So my surmise is that the last 4 or 5 significant growth slowdowns that we have seen have all been supply side shock led. This is the first demand side slowdown we are seeing in a big way, because we always thought that India is a supply constrained economy. Demand is never a problem for us. So once this demand slowdown comes in, it becomes difficult for us to model that because we are not used to seeing demand slowdowns. And that's probably one of the reasons why we got this horribly wrong. But to answer your question that can we see a bounce back, I think the most critical question for me is how much is the difficulty in the informal sector, which we don't have high frequency data to judge. Because I'm pretty sure that the formal sector, with the kind of stimulus that has been given, would bounce back. It's tough to say whether it is a 2-quarter issue or a 3-quarter issue, but it will bounce back. The informal economy is where my doubt is, because I don't have aggregate macro data to analyze that properly. And if the stories are true that that's a segment which has gone through, to use the phrase that you are using here, disruption, or at a worst case die, then that might not respond immediately.
So you don't think the worst is necessarily behind us? You're still looking at 2 or 3 quarters for the economy to start picking up? Swami Kanti Ghosh, the last time something like this happened was when the Lehman Brothers crisis happened, and the economists at that time didn't know what would happen next, because that was really a black swan moment. Here, since demonetization and the announced rollout of GST, there hasn't been a sudden situation where the economists have to deal with an X factor which they hadn't factored in. So why did economists get so many of their numbers wrong? You've now revised your calculations very, very drastically. Do you believe that the second quarter numbers is the worst, or do you think the economy, as Samiran fears, will struggle for a couple of more quarters before bouncing back?
Yes, I think we have also revised our forecast from 6.9 to 5%, and possibly there could be a downward bias. But not only GDP, I think if you look into the Indian economy in the last 2 to 3 years, I think even the inflation forecasts have gone horribly bad. I mean, from 5% to 6%. So, and the reason is that the economy actually has been going through a lot of changes. Not only inflation, not only global growth, not only domestic GDP, there is a lot of uncertainties which are impacting the economy, and sometimes it is difficult to predict how these uncertainties going into a macro modeling. If I give you an example, say earlier when you used to do the growth projections, oil was always an important factor in the projections. But today, oil prices which are $86 a barrel in 2018, today they have crashed to below 50, now they're around 60 to 65. So in a situation when oil prices vary like this, I think sometimes it gets very difficult to predict the projections. Now in terms of whether we have reached the bottoming out, my sense is that there are some sort of green shoots happening. For example, there has been an pickup in credit growth, even though that's marginal. The global growth possibly will, 2020, we may not be looking at a global slowdown, so that could actually positively impact the Indian economy. And the final thing which I base my optimism is that markets never lie. So if you look into the financial markets, at the end of the day, the financial markets, if I put it very plainly, it's only a discounted value of the future cash flows. So if you see that there is some potential in the cash flows, that's why the markets go up. I'm not sure whether I can connect the financial markets with the current growth rate, because they're moving diametrically in opposite direction. But at least if I put that thing into perspective, I have hope that possibly we may have seen the worst of the rates.
You know, as political journalists, we put out exit poll numbers, and you work really hard and you hope that your models are right. Usually they are, sometimes they could go wrong. With economists, you believe, Dr. Goyal, that the economists have it better than the political pundits and they're more likely to get their numbers right, but that's not been the case. Why is that? Do you believe some of the withholding of government data and government reports has really left economists dealing with numbers which could be true, may also not be true. And what's your view on whether the worst in the economy is behind us?
Yeah, I think the economy is going through structural change, and that is why data, we don't know what we are measuring. It could be overestimated, it could be underestimated. So in a way, I am pleased with the latest, with analysts getting their forecasts wrong. Because earlier they were tracking high frequency numbers and saying these are showing that growth should be lower than the CSO is telling us it is. And this time they were actually saying it is higher based on high frequency numbers than the CSO came out with. So it suggests the CSO is not seriously underestimating GDP. We are not actually growing at 2 and 3%. We are growing at 4.5%. So I think this criticism of the CSO has been overdone, because in an economy like India, which is very diverse, we still have a non-modern sector, non-formal sector where it's very difficult to get data. There are more than 600 surveys which are used. And to forecast GDP growth on the basis of some regressions or demand side, a lot of the analysts use consumption, investment, and so on, where the data problems are immense compared to the supply side. Supply side estimates are more reliable. Then there are problems with the consumption data, for example. The NAS shows much higher consumption than the NSS survey shows, the national income data. So now to come to your, I think that we are getting there. We are getting a better feel of the changes conceptual. For example, industry. We're moving from a 4,000 firms database to 3 lakh, out of a 12 lakh database. Then, and that was the big surprise in GDP growth rate. But you need to do that. You can't see what's happening in an economy the size of India with 4,000 firms. And how many firms do we have? And that is why when people say that growth rate is falling, but I agree with Soumya that the level has gone up so much, the diversity of the economy, that there's so much happening. You know, it's very different to what we were with the Hindu rate of growth. It was a very low level. At a higher level, if you have a lower rate of growth, that still means a lot of change. So then about whether we are seeing change, whether we've bottomed out or not, I think to answer this question, we have to look at what caused this slowdown. Now, I don't agree with Soumya that this is the first time we're seeing a demand-side slowdown, because the global financial crisis also was a demand-side slowdown. You know, there's a sentiment, investment fell, consumption fell, everything. We say that the markets, you know, we're supposed to reform, the markets are supposed to lead us, but whenever there's trouble, they look to the government for help. Because there's a fear, the sentiment factor. So that was a big thing after the GFC. And this is global coordinated macro stimulus. It was the first time Indian macroeconomic policy was pro-cyclical. Both the fiscal deficit rose, interest rates were cut sharply, liquidity was pumped in, and growth rate rose from 6.7% to 11.1% the next year. It wasn't measured properly, so we didn't know we were growing so fast. There was overheating. That's why counter-cyclical macro policy can really work. And today, because we are bound by inflation targeting and FRBM, there's a limit. But in a way, it's a good thing, because that was overreaction. We did too much stimulus. Part of the reforms is moving to better systems where there is, you know, you're more calibrated and as markets deepen, you don't need to give such a large stimulus. And I think the immediate cause was really this slowdown in NBFCs. They were providing credit to a lot of hitherto excluded sectors. That demand slowed down, so consumption slowed down, therefore investment slowed down. Again, I don't agree with Mahesh that investment has been slowing down since 2011. It is true, after the tightening, after the overheating, investment fell drastically, but in 2014 there was a rise. Then after that, there was a global commodity price fall, but interest rates did not fall, and you know, so policy was pro-cyclical, and that probably affected investment. But today, although the rate cut is limited by inflation targeting, but liquidity. The other problem was in 2018, you had the Fed raising rates, outflows, and therefore there was aggregate liquidity tightening just at a time when NBFCs sectoral liquidity tightening. So both of these came together, and if you talk to people in the market, they say, you've never seen conditions like this where there's just no money. So now liquidity is again in surplus, durable liquidity. And there are measures, government measures take some time to work, but part of this listening and calibration is adapting those liquidity measures for housing, for allowing BB-rated NBFCs also to benefit from the government warranty, which is the feedback, the correction, which will allow...
So, Jay Panda, the majority of the economists on the panel disagreed with your view that the worst is behind us. You know, Samiran spoke of at least 2 or 3 quarters. Mahesh didn't put a number, but said that it's going to take some time. What then makes you confident that the worst is behind us? Or is the government over-optimistic once again?
Let me answer that question by commenting on some of the points that have been raised and explaining the situation the way I understand it. So Mahesh pointed out that investment has been slowing down since 2011-12. Do you remember why that happened? It happened because of the big scandals of spectrum and coal and other things in 2009-10. And very similar to what happened, you talked about the Lehman problem. Exactly the same thing. Lehman was again a scandal about housing loans which collapsed. Now, our scandals 10 years ago opened up the rot in the banking system. All these loans that had been extended for all these projects that were linked to those scandals had problems, and that's what has led to the extended slowdown in investment. But I gave an example of how others see India much more positively. The outside world has been investing, FDI has been rising in very dramatic fashion. Now, we talked about green shoots or not, I gave you the example of already the bottoming out of GST. And some other comments were also made about that. But let me cite one more example. Cantor, for example, which studies global consumer patterns, has pointed out that in this last quarter, Indian rural demand for domestic household products and groceries has gone up fairly noticeably. So that may be another indication of a green shoot. Now, we can disagree about predicting what the GDP growth rate might be. Now, I've mentioned IMF says it will be 7% in a year's time. OECD has a different number, but also very positive. It says it will be 6 point something percent. If you take a longer viewpoint, recently the Japan Center for Economic Research has given a date of 2029, which is 10 years from today, when India will overtake Japan as officially the 3rd largest economy in the world. Now, we can have different views on the short term and the medium term, but I believe, see, the numbers that we see here now are from the same quarter when the government took all these measures. Now, if you think it was that government didn't take the measures, that's why the economy slowed down, then why did we have 8.2% growth rate in the first quarter of last fiscal? And it had nothing to do with demonetization, which was 3 years before that. So there are many other cyclical factors and structural factors which come into play. Looking at the way most of the world is looking at us, I'm fairly optimistic that if not in the coming quarter, we will see the turnaround in the coming 2 or 3 quarters. Today, for instance, the finance minister has announced another slew of measures. So one of the complaints I kept hearing from industry for the last quarter was that their payments from PSUs and government was stuck. Today, a very major decision has been taken to ensure that all those payments are released. So these are all going to have a very positive impact. But of course, we need to keep working.
The reality is that government finances are badly stretched. So much so, we were in Kolkata just last week, where the Trinamool government, as is the case with other state governments, were complaining about how the central government hadn't released the states funds that were due under law.
Which is why disinvestment, which has not always got the attention that it deserves, today is getting that attention. The government made a very sincere effort last year with Air India, which sucks up $1 billion or more every year from taxpayers as subsidy to keep flying. Now there is a renewed attempt to get Air India disinvested, as also Bharat Petroleum, as also another company. So I think resources can get stretched, but you can also address it with proper policy measures.
So I want to refer to what Raghuram Rajan says in this India Today cover, how to fix the economy. This is widely read, widely quoted, widely being debated. he makes two central points. One, he suggests, Jai Panda, that there is too much centralization of economic decision making in the Prime Minister's office, and you don't have enough experts, genuine domain experts. That here's a government that understands its politics, they know what to do, but they don't have genuine economic experts.
That's a great question. Please give me a minute to answer. Now, Raghu is a friend and he's an acknowledged expert, but I think you didn't catch the subtlety with which Ashima Goyal mentioned that we had experts who did not do what was necessary. So for the 5 years that Arun Jaitley was finance minister, he kept pleading with the RBI that inflation is low, please drop interest rates. That's classic economics. And quarter after quarter after quarter for years, experts did not drop the interest rates, saying that, hey, we expect inflation to go up. And this starved credit to Indian investors, to Indian companies, especially the medium-sized companies. So sometimes too much of expertise can also be harmful to the economy.
Since then, the new RBI governor has reduced interest rates by 135 basis points, which hasn't led to a credit offtake either. A very substantial increase in credit.
No. Let's understand what has happened. What the current RBI governor did was already 5 years overdue, and to his credit, he responded to the data as it was there and the needs of industry. Now, the problem is, if you analyze, the credit flow, the rate cuts haven't been passed on by the banks. And the banks, my information is that most of the banks are sitting on it. They haven't really passed it on to industry. And we need to look at why they need such a big spread to operate. Already some efficiencies have to go up. And that's why bank mergers are necessary, which was asked for by experts for decades. Finally, it is happening. But we also have other challenges now. Now, because of inflation today rising a little bit, it becomes harder to cut rates. We had that option for 5 years, and our experts just did not act on it.
Okay, so there are two contra points of view which are at play at the same time. And I want Mahesh Vyas to come in on this. The first view is that this government doesn't like American educated economists. They are Videshi economists. Their DNA, their blood is not Swadeshi enough. One second, you've spoken, let Mahesh come in. That their blood is not Swadeshi enough, they don't understand what makes India tick, they won't fit into the India story. Then there is the other point of view which says, this government ko padhe likhe log pasand nahi hai. They like yes men. They like people who will immediately yes sir, 3 bags full sir, and do whatever the government and the RSS wants. Which of the two do you believe, Mahesh Vyas, is closer to the truth?
Absolutely not fair, because I am not anywhere close to policy making. I'm not a Delhi person. I just do measurements. And from here I can just say one thing to still answer your question, is there is a need to stop denying that there is a slowdown. And the problem was, whether it is American economists, foreign economists, Indian economists, no matter where you have studied or got your bearings, the important thing is that this government takes too long to accept that there is a problem. There is too much of data which is not getting released. And I think this denial is causing a problem and also causing confusion. So let's look at the question you're asking now is, have we bottomed out? This quarter, we already know that the IIP is down. We know that power generation is down. So this quarter is a washout. This is already gone. So we are not seeing the bottoming out as yet. We need to accept this, that there is a serious problem. Once we accept it, I think we can find solutions. So the problem is not where you are educated. The problem is denial. That's the first problem.
Okay, Samiran, do you want to come in on this? Now, all the economists are looking left, looking right, saying, I'm not certain of how do I answer that question, but it's an important question, Samiran. Do you believe that this government lacks genuine economic insights? Many would say, for example, a deep cut in corporate tax rates is a great idea, but was that the right policy instrument given the challenges the economy faced at this moment? When the challenge is to create consumption demand, right? You reduce corporate tax rates. A Credit Suisse report that came out recently said that 90% of the corporates they surveyed, and they surveyed about 4,000, would sit on the extra cash, keep the cash in their balance sheet as opposed to investing it back. So does this government understand its politics much better than it understands its economics?
So let's put it this way, that there are two different things about addressing a slowdown through countercyclical measures. And there's a different thing about achieving a $5 trillion economy over a 5-year period. I don't have too much quarrels with the first. I think the government is taking enough and more steps to address the slowdown, and as Mr. Panda said, that not everything is in government's control. We have to admit that there are limitations for the government as well. Where I think as an economist I might have some quarrels is about the $5 trillion economy part, and whether we are having enough economist inputs into how that $5 trillion economy will look like. Is it going to be a primarily manufacturing-led economy, primarily services-led economy, export-led economy? I think we need to do a lot more research in shaping that $5 trillion dream rather than just harping on a particular number. And that's where I think as macroeconomists we have a contribution to make. I don't think I have a great contribution to make in saying that in labor reforms such and such act and such clause needs to be tweaked. That's not my domain also. So I think if the government uses economists for their domain expertise, that's more for slightly more medium-term planning, not just responding to economic crisis.
Swadeshi economist Ashima Goyal would allege that Videshi economists don't understand the Indian economy, whereas Videshi economists would allege that Swadeshi economists gave us gems like demonetization, which we're still trying to recover from.
And I don't think you can put all Swadeshi economists in one bucket or all Videshi economists in one bucket. But I think an economy like India is complex. And agreed, we want to develop and reach the American system, but we are not there today. So if you don't listen to what is happening on the ground, I think today even Raghu admits that the decision to keep the liquidity adjustment facility in deficit was incorrect. They didn't listen to feedback from a lot of industry that said we are starved of liquidity because they believed that they had all the answers. The US system works with the liquidity in deficit. So, but at the same time, you need a framework. You don't need to be absolutely out of your hat, pluck strange ideas. You have to be part of the discipline. And I assure you, most Swadeshi economists are very well educated in the economics discipline. Yeah.
Rahul, you should have had at least one Videshi economist in your panel to defend them at least. We are all Swadeshi economists out here, none of us are Videshi.
Rahul, I think
despite his card reading Citibank, Samiran just lets us know very quickly which side of the Videshi-Swadeshi divide he's on. Yes.
I think it's unfair to say that the government is in denial because, right last quarter when you saw the stock market dropping in June and July, the finance minister started consultations with stakeholders across the spectrum, including economists, industry, so on and so forth. And you started seeing actions taken within a month. So I don't think that's fair. And as others have pointed out, all these actions take 2 or 3 quarters to have an effect. Secondly...
No, but one second. What does it say about the level of economic understanding of the government that it takes the stock market crash for the government to realize that the economy is not doing well, whereas you had an opportunity during the budget to actually roll out the same measures. Instead of doing so then, we've had 4 mini budgets after that.
It just happened, look, we had an election process and that's one of the issues of being a democracy. Some countries that don't have elections can focus on the economy all the time. But I would say this, despite all that, we had these experts who did not respond to the ground realities as others have pointed out and I have pointed out. And today we do have experts of various flavors who are responding. The RBI has responded to the high interest rates and has reduced them. Today also you have ministers in the government, you have experts, economic advisors in the government who are foreign educated, who are educated in India of all kinds. So I think that's an unfair allegation to make.
No, why the government says Harvard se kuch nahi hota, hard work se hota hai. So there's too much emphasis on Josh and not enough emphasis. And now if you speak to corporates and you speak to money managers, you can say what you want on the Citizenship Amendment Bill, you can say what you want on Article 370. Ultimately, money has a mind of its own.
Look, does anybody quibble with the steps that the government has taken? Does industry quibble with tax rates being cut? Are you unhappy with it? No, that's not true.
No, actually, this interest rate cut, this tax rate cut is also strategic because you're at a time when you want to attract FDI, which is leaving China. So you need to reduce corporate.
But ma'am, in reality, if global value chains are being reorganized, how much of the investment that's leaving China is actually coming into India? It's going to countries like Vietnam, it's going to countries like Philippines, it's even going to countries like Bangladesh. Very little of it is actually so far come to India. And when in a state like Andhra Pradesh, the Chief Minister Jagan Reddy announces that he's going back on his predecessor's decision, what's the message you're sending out to the consortium in Singapore that took the decision to invest in the India story?
No, I mean, India has advantages because of its size, its own domestic market. So if we get some of these policy, ease of doing business, labor reforms, consistency in policy, as well as tax, which is competitive with other countries, then we will attract people. And I want to say that if you are an investor, then you have to look forward. You have to see India's size and potential, and you have to be there.
No, but Jai Panda, I was speaking to Indira Nui just yesterday, and she gave a very interesting perspective of how the world is viewing India. India forever has been seen as a country of potential and performance. Now people are wondering internationally whether that is actually true. If, for example, we're sitting in Mumbai, where the new chief minister has announced that all major contract decisions, including the contracts that we have with the Japanese at very low rates of interest to build a bullet train project, the metro project in RA, all of that will be reviewed. Which international investor, look at what happened in the e-commerce sector, for example, where you spoke of e-commerce as being one of the shining lights. Suddenly the regulatory changes because the populist pressures wanting to save the small kirana stores. You upturn regulation midway through, and how does that impact the investment cycle?
In a large and diverse country like India, there will always be pressure groups who will want changes in policy, whether they are kirana stores or whether they are consumers or corporates. That's normal. There's nothing to be seen as abnormal. Some of the investments that are leaving China are indeed coming to India. Samsung is one example in terms of its telephone production factories. Some of it have come to India. But, one of the reasons that we were held back is because of labor laws. Let me tell you, I come from a business background, and I know that companies in India over a certain size bend over backwards not to employ people because of the 200 odd laws that we used to have. So after decades, the streamlining now of those 200 odd labor laws, which Jagdish Bhagwati has written extensively about, how they contradict each other, how they inhibit investment and job creation, are streamlined into 4 categories. I believe this will help attract a lot more of the manufacturing investments and create more manufacturing jobs that we've been looking for.
So we're running out of time. I have one final question to ask all our guests, and we'll keep it brief. I'll start with Soumyakanti Ghosh. Do you believe we are at this moment on track to achieve the 5 trillion economy target by 2024?
See, I think 5 trillion is just a number. So we are looking in terms of just a number, and if you look into the history of the India, just I mentioned, India has added 150 lakh crores in 10 years. So mathematically, if you look into it, it's possible, but for that we need to do certain things right. The most obvious point which you mentioned is the policy continuity, and just to give a positive vibe to it, recently we did a study of our sample, 11 lakh sample, to find out whether consumers were spending or not. We found out that consumers in small cities, which are not even 1% of the Mumbai population, our median spend is 40% more than what they're spending, a Mumbai guy is spending, the online spending. So people are still uncertain about the spending, and until and unless you have a continuity in policy, that is not going to go away, and that will be the most crucial thing in India attaining that 5 trillion goal.
Okay, Mahesh Vyas, ceteris paribus, things being the way they are we on track to be a $5 trillion economy?
No.
Samiran Chakraborty. I'll come to him. On the stage, government has the last word. In elections, it's people who have the last word. Samiran.
So, very simply put, we need to grow at 8% real GDP growth to get to $5 trillion economy. We did a study of about 25 countries for 70 years to see what are the two preconditions needed to grow at 8%. One is 10% investment growth, the other is 3% productivity growth. If you meet these two conditions, then with 95% probability you will hit the 8% growth mark. So now I leave it to you to decide.
As of now, we're not hitting that. See, this is
So right now we are not hitting.
But Samiran is a good candidate for the Indian Foreign Services. You know, he has the knack of being able to say what he wants without answering the question straight. Are we on track, Samiran, at this time, in your view, to hit $5 trillion by 2024?
So honestly, I don't think that both these conditions are unachievable. Just 10 years back, we have done it. So why would I say that in next 5 years we will not be able to do it? But it's also not that if we think that we are on an autopilot and just by the grace of God we will get it, that's also not going to happen. So we have to really work hard to meet these two conditions.
Ashima Goyal, are we on track for $5 trillion?
I think one thing is that we get stuck in the status quo. We see 4.5% and we need 8% rate of growth or nominal growth of 12% to reach 5 trillion. That looks really difficult. But you know, I've studied our past growth episodes. So in 0304, there was a jump in private investment. And you know, something like that can lead to a switch from a slowdown to faster growth. So currently, what can give such a switch? Is there anything that can give such a switch? Well, one thing is sentiment. Sentiment changes. Because when you've been repressed and you know there's fear and so on, and you release that, it can jump up. So it depends if we see this kind of switch which leads, and today the government can't do it. But what it can do with counter-cyclical policies is to increase spending. It's the marginal rise in spending which can, you know, which is larger than the savings that can lead to such a switch. So maybe we can't have a big jump in investment unless FDI really comes in, you know, that might, or there's
so
a
you're
sudden
basically
switch in
saying at this
sentiment.
moment we're not on
Yeah,
course. Lot
but
needs
if
to
there
change.
is this switch,
Because we need a
then-
nominal rate of growth, Panda, of 12% to be able to hit the $5 trillion target. And there are two problems. One, our current growth level is at 4.5, with at least the next couple of quarters being bad. And we've got inflation that's creeping up. So you've got growth that's falling, you've got inflation that's rising. That's like Duckworth and Lewis in cricket in action, where the run rate is just, you know, turning adverse. How do we think, will this be another Jumla? Or will we, do you think, really hit $5 trillion by 2024?
Boy, you really have a lid on the glass being half empty. But let me answer the glass
I'm
half
just
full.
stating facts for what they are.
Let me
You know,
answer.
unlike, you know, I can't
let me
keep saying the situation is normal,
Let me answer
the
why I
situation is
see the
normal
glass
if it's
as
not.
half full. Let me answer. Give me 30 seconds, and I'll answer why I see the glass as half full. Fortunately, economic growth rates are not linear. Because it's 4.5% today doesn't mean that's the way it will be for the next 5 years. You just heard an example of how it was 6 point something one year, went up to 11 point something the next year. So I certainly think it is possible that we can reach $5 trillion GDP size by 2024. But suppose we are off by a couple of quarters. Now, I think it's important to have set that milestone as an aspirational milestone. I want to give you one quick example. 5 years ago, the Prime Minister said that being 142nd on the ease of doing business index is too bad. We need to be in the top 50. 5 years down the road, we're at 63, just short of the top 50. But isn't that a creditable achievement to have come 73 points from there? So I think we can still make it, even if we are off by a couple of quarters, not a big deal.
You know, I think there can be no argument with the fact that setting ambitious targets, staking your prestige and reputation on the line and working towards achieving those is far better than just sitting back and saying we're fine with where we are, even if we are 140th when it comes to the ease of doing business ranking. So the government has set ambitious targets. We just hope that in the end they don't say that was just an election jumla. They actually work towards making that happen. We've seen some significant policy corrections. And in India, the famous saying goes, never miss a crisis. And the crisis is the best opportunity to actually administer economic changes. Otherwise, everybody's very settled with the way things are. So we're seeing some changes finally, and let's hope that they take us towards a $5 trillion economy, because getting there is in the advantage of everyone who's here and who's watching on television and on social media. I want to thank this very distinguished panel for joining us for what's been a very interesting conversation in the state of the economy. Thank you all very much. Thank you.